Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another financial podcast from the Cambridge Financial Podcast channel. As you all know, obviously our number one goal is to make certain that our clients and friends are well educated, as well as all of you on this podcast that are listening to us on a weekly basis regarding the different topics that we bring to the table involving insurance, risk management, and investments. Now, today's podcast is going to be how to analyze commercial real estate properties. And this is one of the areas that we do a lot of work on behalf of our clients from a business perspective. Many of our clients are either in the real estate marketplace or in the real estate business on a full-time basis, but we do have a lot of other clients that do it on a part-time basis. In other words, they either have a job or they're an executive for a company, and then they invest on the side on real estate properties and so forth. Now, one of the critical aspects of purchasing a property, for those of you that have done it in the past, these are properties that are purchased primarily from an investment standpoint. So there are a number of things that we do for our clients in order to help them identify the right properties to purchase. Many a times, clients are bringing to us 2 or 3 properties that they have already done some of their due diligence on, but now they need some financial calculations, and at least they want a third ear available that has some experience in calculating internal rates of returns and so forth. We at Cambridge use a 5-step process, and these are 5 sets of calculations. Now, we do a lot of other stuff that we'll talk about in a little bit, but primarily there are 5 major calculations that we do for our clients on a regular basis when they're trying to purchase a real estate property for investment opportunities. Number 1 is doing income and expense calculations. Number 2, net operating income, or NOI, as it is known in the industry, calculations as well. Cash flow calculations is number 3. Cash on cash return is number 4. And last but not least is capitalization rate, or better known as cap rate in the real estate industry as well. Now, obviously, one of our key goals is to make certain that, as I stated earlier, that our clients are well educated, because at the end of the day, information without education always leads to failure. So when we're in the process of analyzing a piece of property for a client as part of the due diligence that we do on their behalf, we want to make certain that at least they understand what they're getting involved in. And when we do the first set of calculations on income and expenses, it is critical to understand that income is the lifeblood of commercial real estate, and it comes from all the rents that are collected throughout the month, the lease payments, laundry income, late fees for tenants that may not be paying their rents on time. There's always a percentage of those that need to be taken into consideration. So all of that adds on a monthly basis, and it becomes income for that property at that time. Now, there are also operational expenses that need to be taken into consideration, and this includes the cost of operating the property or the real estate. For instance, you have insurance costs, you have taxes, you have utilities, you have repairs, you have maintenance, you have landscaping, you have property management fees if you use a property management company. One of the things that we try to make certain that our clients understand is that we don't include mortgage expense in operational expenses, because mortgage expense is not an operational expense, it is a debt expense, and we'll cover that later on. Now, in every area and every calculation that we do for our clients, we also have what we call rules of engagement. These are the things that the clients should be able to watch for as we go through each and every one of these calculations. So in the area of income and expenses, the number one rule of engagement is you want to make certain that the income is greater than the expenses, because otherwise you're going to have a negative cash flow, and you're going to have some major issues in the future, depending on economic circumstances and such. Now, once we do the income and expense calculations, the net set of calculations that we do for our clients are what is known as net operating income, or NOI. Now, the higher the net operating income, the higher the net income and the value to the property. And net operating income is nothing more and nothing less, and you're taking the income on the property and then you deduct the expenses. Now, one of the interesting things about the NOI is that the banking industry in the United States uses the NOI, or the net operating income, as a leveraging lending tool in order to determine whether this is a viable property for them to finance, and if so, at what level would they want to finance this property based on the net operating income, which will then turn on become part of their internal rate of return that the bank has set up for their lending partners and so forth. Now, the number one, again, rule of engagement when doing net operating income calculations is that the NOI must be greater than the mortgage payments. Okay, now remember, we did not include the mortgage payments inside the expenses. So the next set of calculations now will take that mortgage payment into consideration. And the next set of calculations that we do for our clients, once we've done the income and expenses and the net operating income, is what is known as cash flow. And pretty much cash flow equals the net operating income minus the mortgage payments. And I'll give you an example that will hopefully help you identify, some of these issues as we go through this podcast. But cash flow equals the net operating income minus the mortgage payments. Now, obviously, the higher the cash flow arbitrage, which means the difference between the mortgage payments and the NOI, the higher the leverage for the owner and or investor when it comes to financing property and obtaining property financing deals that are better than what the market may be able to offer somewhere in the marketplace, because of the fact that you do have an arbitrage and you do have a positive cash flow after you pay all the expenses, including the mortgage payments. Now, a rule of engagement that is very critical when dealing with cash flow is that you're always going to have positive cash flow. And the higher the positive cash flow, the better it is from a business perspective. Now, again, once we've done all the income and expenses and the net operating income calculations and the cash flow calculations, we go and move forward to the fourth set of calculations that we do for our clients, is what we call cash on cash return. Now, the cash on cash return calculation is one that is not very well understood by real estate investors, unless you just happen to be in the business on a full-time basis, and then obviously you're going to become very savvy at not only doing these calculations, but dealing with people like myself and companies like Cambridge in order to have good discussions as to how all of these calculations fit on a particular property from a business standpoint. Now, cash on cash returns, it determines how fast is the money moving. In other words, how fast can I get my money back if I make an investment in a piece of property? So, for example, if you're able to get your investable assets back in 1 year, then it's 100% return when it comes to cash on cash. If it's in 2 years, it's a 50% return. If it's in 3 years, it's a 33%. If it's 4 years, it's 25%, and so on. In other words, from a financial perspective and from an economics perspective, we look at cash on cash as the velocity of money multiplier. How quickly can I turn my money over and over and over on a monthly basis or on an annual basis in order to enhance the viability of the investment that I have made. And those are things that the banks pay a tremendous amount of attention to, because the banking industry works primarily on velocity of money multiplier concepts. Now, the calculation or the formula for the cash on cash return is the annual cash flow divided by the down payment. So the rule of engagement there is that cash on cash returns must be greater than 10%. If it's less than 10% return cash on cash, we recommend to the clients. Obviously, we can't tell the clients what to do, but we do make certain recommendations that may move the clients away from making that investment in the long term. So those are things that are very, very critical to understand on cash return. Now, the last set of calculations that we do for our clients is what we call the capitalization rate. So once we've done the income and expenses, the net operating income, the cash flow, the cash on cash return calculations, then last but not least, we do the cap rate calculation on behalf of our clients. And in a nutshell, the cap rate calculation is the net operating income divided by the sales price of the property. And again, I will give you an example that will give you an idea as to what we do in order to identify whether a given property is the right property for a specific client depending on their goals and objectives. Now, interesting enough, the higher the cap rate, the higher the risk. And because the risk is higher, most of the time the properties are going to be a lower type price property in the marketplace. So at the end of the day, the higher the cap rate, the higher the risk, and the lower the property price that someone should be able to pay. Now, on the other side of that structure, the lower the cap rate, the lower the risk, and the higher the property price. Now, the one main rule of engagement that we have for the majority of our clients, now obviously there's an exception to every rule, but the number one rule of engagement that we have in the capitalization rate calculation is that it has to be greater than or equal to at least 8%. If we cannot get a cap rate for a client at 8%, then obviously there may be other properties out there that may be better suitable for a client. Now, I do have clients, and I'll use this as a disclaimer, that we have done these calculations, and we have a cap rate of 6%, and they feel very comfortable with a 6% cap rate. Their older clients are thinking more about income. They're thinking more about the structure and the viability of that income, and they're willing to take less as long as they have more security on their side. So again, every client has to make a decision, but our goal and objective is to make certain that we give enough information to the client so that he or she will make the adequate decision at the given time. Now, obviously, we have covered the 5 major areas of calculations that we always do on behalf of our clients when we're asked to. And again, those are the income and expenses, and net operating income, cash flow, cash on cash return, and capitalization rate. So now what we're going to do is we're going to give you a commercial real estate example. Now, this is an actual example. This is an actual calculation that we did for a client about 2 months ago, and you'll find exactly what it is that we did from a business perspective. Now, in this example, the property value was $500,000. Our client in this situation was a small LLC that wanted to purchase a property put a down payment of 25%. So the property was valued at $500,000. They put in $125,000 of down payment. The annual mortgage payments were at $25,000, so the client was going to be financing the rest of the property, or the difference between the $500 and the $125. So it was going to cost them $25,000 in mortgage payments annually. And the property was generating at the time $58,000 of annual income. Now, I do have some very, very conservative clients that, instead of using a 12-month period of income calculation, they feel more comfortable using either 11 months or 10 months. Why? Because you may have tenants that leave after their lease is ended, and it may take them 30 days or 45 days to re-rent that property. So they feel more comfortable using a 10-month calculation as opposed to a 12-month calculation. But in this scenario, the client wanted to use a 12-month calculation. So the income coming into the property was, or to the LLC, was $58,000 a year. So now we have a property valued at $500,000, a down payment of $125,000, annual mortgage payments of $25,000, and income of $58,000. Now the expenses on the property was $16,000 a year. So you take the income, you deduct the expenses, and now you are left with a net operating income, which is the income minus the expenses, of $42,000. 58,000 minus 16,000 equals $42,000. Then we proceeded in this property to do a cash flow analysis, which is now the net operating income minus the mortgage payment. So in this situation, the mortgage payments were $25,000. So $25,000 minus the $42,000 of net operating income left a cash flow of $17,000 per year. So in this example, the cash-on-cash return, which is the cash flow divided by the down payment. Now, if you'd recall, the down payment on this property was 25% of $500,000, which was $125,000, and we do have a cash flow of $17,000. So the cash-on-cash return on this property is 14%. The cash flow of $17,000 divided by the down payment of $125,000 gave our clients a 14% cash-on-cash return, which was very good from a business perspective. Last but not least, the cap rate, which is the net operating income, or NOI, divided by the sales price, which in this case was $500,000. So now we see that the NOI was $42,000 divided by $500,000. That gave our clients a cap rate of 8%, which in this situation was the adequate amount that the clients were looking for. Now, obviously, when you look at a property like this, it makes all the sense in the world if you're interested in investing in real estate for the long term and you want to do it for income, you want to do it for diversification, to do something along those lines and generate this kind of property. And if you have the cash flow at your disposal, then obviously this is something that you can try to emulate, once a year, twice a year. I have clients of mine that have made it a point of purchasing 2 to 3 properties a year for a maximum of 10 years, or anywhere between 5 and 10 years. And I have them at all different levels. But this would be an example of a good property to acquire. Now, once we do these 5-point calculations for our clients, obviously the key here is, well, what if some of those calculations may not be up to par? Then the question is, okay, so how do we measure which calculation may be better than others? So obviously when you start to do that, then you got to start putting those different 5 points in a chronological order, and then educate the client and or allow the client to figure out which one of these points may be the most critical for them, depending on where they're at from a life income or investment perspective. Now, some of the other items that we consider when we do these calculations for our clients is, number one, the purpose of the investment. Is a client looking for income? Are they looking for growth? Are they looking for growth in income? So in other words, if I have a client that is looking for growth, they may be in their late 40s, early 50s, say they're both professionals, they're making plenty of money, so they don't need income from this piece of property to make ends meet. They may just want the income that is generated to either put aside and invest it somewhere else, or facilitate the prepayment of the mortgage so they could have a free and clear property at some point in time in the future. So it really depends on what the purpose of the investment would be. Now, obviously, for those clients that want a combination of both, so they want growth and income, they want the property to grow based on the location. It's all about location, location, location. And then obviously they're also looking for income to either reinvest or help them sustain their standard of living. Another item that we look in consideration on assisting our clients is the length of the investment period. Now, we do have clients that are interested in, buying a piece of property. They're fixing the property. They may want to keep it 2 to 3 years. They may want to refinance it, and then they just want to flip it and sell it to the highest bidder. We have others that have a more long-term approach. So they want to buy a piece of property and they want to keep it for many, many years to come. Another big issue that we address as part of the other items is the income arbitrage utilization. In other words, if you have positive cash flow after you've done all those calculations, what are you going to do as an investor with that positive cash flow? We have a number of clients that set up a separate account. They can start putting that money in there and then using that money to purchase another property down the road somewhere. Others want us to create financial product straddles whereby they can take that income, that net income after paying taxes, and putting that money into vehicles that will now generate tax-free income for life, and also will allow them to diversify their income risk from a business standpoint. Another item that we look at is, the property condition and future maintenance forecast. So obviously in this type of property, when the client purchases it, they know that their expenses are somewhere around $16,000 a year, but that's today. What would happen 4 years from now or 8 years from now? Is the roof going to have to be replaced? And if so, what would be the cost? And what would be the NOI if we factor that in, let's say 4 years from now? Can the roof be repaired? Are we going to have to repave the parking garage or the parking lot? What are some of those additional maintenance forecast that this property owner may be looking at 4 or 8 years down the line? Now, obviously, if you're a short-term investor and you just want to purchase a property and then flip it 2 to 3 years down the line, they're not going to make as much as an impact as if you happen to be a long-term investor and you want to keep this property for 10, 15 years down the line. So obviously, those are things that need to be taken into consideration. Last but not least is, the need for a management company. I do have clients that are now retired that obviously want to stay active, want to stay busy, so they manage their own real estate property. So I have a very good client of mine that owns 8 properties here in the Miami and Coral Gables area, and once a week he goes out and does his rounds and makes certain that everything is fine, and spends time really getting involved in the property business. Now, I do have other clients that are in the real estate business, so they have 15, 20, 25, 30 properties, so obviously they need a management company in order to manage those properties for them. I do have certain clients that actually have created their own management company themselves, but I do have other clients that have been able to just give that to a third-party management company, and obviously that company is going to charge them a fee, which will become part of the overall expenses of the managing of the property. Now, obviously, anyone that gets involved in real estate investment does it for a number of reasons. And obviously, it would be important for us to finally talk a little bit about the tax benefits of commercial real estate. Now, obviously, if you look at the marketplace in the United States overall, you'll see that the United States government collects $2.1 trillion in income taxes annually. And that's an enormous amount of money that is being collected by the U.S. government. On the other hand, the U.S. pays out $7.1 trillion annually in tax benefit. So they collect $2.1 trillion, but they're paying out $17.1 trillion. So how long do you think that the U.S. government is going to be able to play that game? Now, if you happen to be a W-2 employee because you have no real estate investments of your own, you've never thought about being a real estate investor, I have some bad news for you. And the bad news is that W-2 employees pay the most amount of taxes in the United States because of how the U.S. tax system works. Now, there are some W-2 employees that have some real estate ownership, so they do receive certain tax write-offs up to a maximum of $25,000 as long as their adjustable gross income, or AGI, is lower than $100,000. So someone that may be a W-2 employee but also does a little bit of real estate on the side is in a better financial position from a taxable standpoint than someone who's a straight W-2 employee. Now, for those individuals that are not either straight W-2 employees or W-2 or straddle W-2 with real estate ownership, but these are straight real estate professionals or real estate investors, they actually pay the least amount of taxes in the United States due to the maximum amounts of loopholes and write-offs that they can take for their investment property income. And that includes depreciation on the properties that are purchased. So it's very interesting to understand how our tax system works. And because of the fact that we also do tax planning for our clients at Cambridge, one of the things that we do for our clients is we do tax forwarding client. And obviously bear in mind that in the traditional world of tax planning in the U.S., capital gains do receive a much higher tax benefit than ordinary income. And the reason is simple. The U.S. government and the U.S. as a whole, being a capitalistic society, they're always looking for Americans to invest in the U.S. economy. And when you become a real estate investor, you're investing in the U.S. economy, or if you happen to buy a stock, and you hold that stock for at least a year, you're assisting the growth of a potential public company. The same if you happen to be a business owner and you are providing certain services to your community. The IRS and the U.S. government is going to give you benefits that you would not otherwise receive from any other source compare. So with that being said, I hope that all of you have enjoyed this podcast from a business perspective. And for those of you, I do have a question that came in regarding real estate depreciation. Remember that real estate depreciation excludes the land value. So if you have a property that is valued at $500,000 and the land is valued at $100,000, and you can take the $400,000 differential and you can depreciate that property over 27 and a half years. Again, our job is to make certain that our clients and the people that enjoy listening to our podcast, that they change the way they see things. Because when they change the way that they see things, the things that they see change. Have a wonderful day and enjoy the rest of the week. Thank you.